Good morning. Welcome to Stock Market Today for Monday, March 9th, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today where you can sign up for a free email where we get a lot of the content for this show as well as give you daily stock ideas to consider. It hits your inbox every trading day before the market opens. So only can be described as a wild weekend, but let's recap Friday first, where U.S. equities ended lower with all sectors closing down on the day. Energy and financials were the biggest decliners. Healthcare and consumer staples outperformed. Treasuries were stronger and continued to get stronger over the weekend. The dollar was down on the major crosses. Gold finished up 30 basis points. WTI crude is the big story here. Settled down 10% on Friday, and in the futures market last night, opened down by more than 30% after the collapse of the OPEC plus production cut agreement. Now, a little bit of a wild ride here overnight. S&P futures have traded limit down for most of the overnight session, off about 5%. And that's on the heels of the major markets finishing higher on the week last week, but closing weekly. Asian markets were sharply lower overnight, with Japan down over 5%, Hong Kong off more than 4%, and China just about 3%. European markets are under a lot of pressure as well. Treasuries are extending their rally, with the 10-year yield down around 50 basis points and the 30-year yield below 1%. The dollar is weaker on the major crosses. Gold down 30 basis points, and WTI crude, as of this recording, is down by about 20% to get us going during the new week. So let's take a look at the structure here of the S&P 500. Now, what we can say is that selling pressure does continue as the index trades below the 200-day moving average, which is in the process of shifting from rising to flattening out. Okay, we did hold near-term support at the 2,900 level on Friday, but already futures markets are trading down here, down around 28.20, where they have gone limit down. When the futures trade down more than 5%, a circuit breaker kicks in, and they can't trade lower until the next morning's opening. Resistance is in the zone now between 3,000 and 3,100, and I realize these numbers are moving around quickly, but that's just the nature of the market. You'll notice that the 200-day moving average is right in the middle of that range at about 30.51. The RSI is still in bearish ranges and likely heading lower here today. Chaikin money flow is bullish to start the week, but here as well, wouldn't be surprised to see that one head lower by the end of trading today. So what I see here is some near-term support right around where the circuit breakers kicked in, near the lows from the summer consolidation. Should we break those lows, which looks very likely, we have to start thinking about 2,700 to 2,750 and possibly below. Now is not the time, in my opinion, to catch the falling knife. We've been saying we want to see a less intense low if you've been reading along in our notes, and we're still looking for that. So let's turn now to our market in a minute. What are we writing about today? Well, futures trade limit down in the overnight session. Oil falls as Saudi Arabia slashes prices over the weekend. As I said, crude oil was trading down about 20% in the pre-market, opened down 30%. But what's interesting to me is energy is going to be in focus today. It's been a sector to avoid for more than a year, and we've been talking about that. Treasury yields tumble further, 10-year down around 50 basis points, and high yield is going to be in focus today as energy makes up about 10% of that group. Gold remains a safe haven in times of fear. Turning now to the major indices from a power bar perspective, all finished lower yet on Friday. Dow down nearly 1%, 1 to 6 bulls to bears there. S&P 500 and NASDAQ both down around 1.7%, 26 to 115. Bulls to bears for the S&P 500. The NASDAQ clocks in at 7 to 20. Small caps were an underperformer once again, 117 to 441. Bulls to bears there. Big, I mean ferocious rally in bonds on Friday to send yields lower, and that is extending in pre-market trading here this morning. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bearish. The major indices across the board are mixed, but what I will note is that all three of the major market ETFs that we track, IWM, SPY, and QQQ, are now below their declining long-term trend lines. So that is obviously a shift. Those long-term trend lines have not been declining for some time. They are now indicating that the trend is now lower for the market. Turning now to our stock of the day. Remember, the stock of the day is auto-generated, and I analyze it for you here in real time. And today's stock, based on the power gauge rating of very bullish, is Armstrong World Industries. Building products stock closed at 105.21 on Friday, down 3.5%. Power bar ratio is very bullish due to very strong earnings performance, very positive expert activity. The stock does have weak financials, excuse me, but the 20 factors kick out a very bullish Chaikin power gauge rating for a stock that coming into today is in a strong trend above the rising long-term trend line. Also a strong industry group. We look at the industry groups based on their power bars, and building products does remain strong. Although we'll see how that plays out following trading today. What I see here is a personality change for this stock that goes from an underperformer to an outperformer and now catches that very bullish rating. Overbought, oversold indicator rounding higher, not quite at an overbought level yet. Chaikin money flow mixed to slightly bullish. I think this is one of the names that I would add to a bullish watch list. I think in times like this, I've said it before, I'll say it again, you want to look for the stocks that have held up the best. And that could mean just, gone down less than the overall market. Because, when the market does stabilize and begin to move higher, those are your likely leaders coming out of the downturn. Now, I think it's too early. I don't think anybody needs to be a hero here. I think there's a lot of moving parts between coronavirus and now the breakdown in OPEC talks on oil production cuts and Saudi Arabia's move to slash oil prices. In my opinion, no need to be a hero here. If you've been stalking some names that you've been wanting to buy and they've had some decent relative strength, keep paying attention to those, look for levels where they begin to stabilize. But right now, I do not see a need to go out on a limb just yet. Turning now to the sector tracker, movement of the major sectors over the last 5 days. And we could see very defensive, very fear-driven at the top of the list, right? Utilities, defensive area, benefiting from that decline in rates. Staples, defensive area of the market. These companies sell the stocks, the goods that you need, not the goods that you want. Healthcare can be seen as defensive in certain parts of that sector. Real estate, obviously defensive, obviously a beneficiary of lower yields. Materials and tech round out the groups that are higher over the last 5 days. Now at the bottom of the list, industrials, discretionary, comms, all lower. Financials under a lot of pressure on a relative basis now that rates have, there's no two ways about it. Rates are looking like they're going to zero here in the U.S. And energy, been a big underperformer, right? Last week I started to say that I was getting tired of talking about it. I'm glad I didn't get completely tired of talking about it because it's just been an area to avoid. We've been saying it for a while. It's under immense pressure. And no signs of that abating here in the near term. No need to get excited about the energy group just yet. I mean, oil is trading down 20% in the pre-market. Now, could this be the capitulation? Could this be, right, the area where everybody has just kind of thrown in the towel on crude oil and on the energy complex? Yes, it could be. But we'd rather wait to see signs of stabilization and not try to catch that falling knife. Our industry in focus today, home builder services, which in theory should benefit from lower rates. But over the past 6 months, it's been only an inline performer, right? Outpacing the S&P 500 by only about 60 basis points. Power bar ratio is weak. 6 bearish stocks for 3 bullish stocks, but it is currently ranked number 3 of 21 subsectors, having moved up 5 slots over the past week. Now, some of the names in this group you want to avoid: Leggett and Platt is very bearish. Allegion, ALLE, is very bearish, and AO Smith also very bearish here at Chaikin Analytics. For those of you who are Chaikin clients or those of you who are taking part in the 14-day trial that we offer, you'd be able to see these very bearish names. But as we look at the group, it's a mixed to bearish picture, what I would say, which kind of surprises me a little bit, but the market really doesn't care what surprises me. I would expect falling rates to be a benefit to this group, but it is a neutral ETF rating, and the trend is weak, below a now declining long-term trend line. We touched on the power bar ratio here, 6 bears to 3 bulls. Now, what I see is very bearish Chaikin money flow, and a stock like the fund is, like we said, been an inline to slight underperformer, neutral rating. It's oversold. Again, don't want to be a hero out here, not willing to step in and catch the falling knife in anything. We want to see signs of stabilization in the market before becoming aggressive on the areas that have held up the best. Turning now to our trending names, movers and shakers from Friday. Cabot Oil and Gas bucks the trend in the energy complex, up nearly 10%. Didn't see anything company specific to drive trading there. Gilead is a coronavirus play. It's a neutrally rated stock. It did catch a downgrade here today, but it was up 5.4% on Friday. Alaska Hour gave an update on trends. Investors like what they heard. Maybe it was less bad, up 4%. IR has been a volatile name over the past week, up 3.5%. And WBA up on the Kroger print as they have a partnership that is Walgreens Boots Alliance, WBA up 3.5% on the day. On the loser side of the board, well, it's very thematic in nature. Oil was down 10% on Friday. The energy names under immense pressure. And I think we're going to see a lot of attention focused now on high yield. FANG, F-A-N-G, that's Diamondback Energy, down 16.58%. Devon Energy down 16%. XEC 15%, Apache APA 15%, and Oxy down over 14.5%. All of these stocks are bearish or very bearish at Chaikin Analytics. All of these stocks are part of that energy complex where we said we didn't see any reason to get excited. We didn't see any reason to go bottom fishing, and that does remain the case. Expect these stocks to be under pressure once again in the early going on Monday morning. So as said, high yield is going to be in focus today. Energy makes up 10% of the holdings in the iShares iBox High Yield Corporate Bond ETF. Now, this is actually a good proxy for risk in the market, right? Very high correlation between HYG and the overall equity market. And what we can see is a very similar dynamic to that chart that we saw of the S&P 500. We've broken below the 200-day moving average as we've sold off over the past couple of weeks. The RSI, after failing to become overbought on a recent rally attempt, has shifted into bearish ranges, and as of Friday's close was not quite oversold. Now, I do expect that to change today. Chaikin money flow is bullish for the group as well. Now, I left this chart pretty much as is and didn't really mark it up so much, just to kind of give you a clear picture of what's going on here. What I think as equity investors is we're going to want to see signs of stabilization in high yield to give us clues if we're going to see signs of stabilization in the equity market. Now, we often show this chart relative to treasuries. We showed it on Friday. It's completely fallen off a cliff, right? And we're going to start to think about what these lower oil prices could mean to highly leveraged energy companies, right, where an energy is 10% of this group. I don't want to be alarmist, but there's a very real possibility that we could see some companies go out of business and struggle due to their high leverage and now the precipitous decline in the price of oil. So just something to be aware of. High yield, I think, is going to be in focus today. And I think it should be in focus for investors all the time. We look at it on a relative basis to treasuries to get a sense of risk appetite. But until we see signs of stabilization in HYG, or if you want to look at JNK, which is the other junk bond fund, we want to see signs of stabilization there to point to potential signs of stabilization in the equity market. Now, as by extension, all eyes are obviously going to be on energy today. Crude oil, as I said, opened the overnight session last night down 30%. It's trading down about 20% as of the recording of this show. As we take a look, though, this is not a new trend. What's happening now to the energy complex is not new. It's an acceleration, right? There's been a catalyst to drive it lower even still. But if we look at XLE relative to the S&P 500, it's been in a clear downtrend below a declining 200-day moving average. XLE has been bearish or very bearish at Chaikin Analytics for some time. Take a look at the fund. 18 bearish or very bearish stocks, 0 bullish or very bullish stocks. And even when crude oil has tried to rally, energy has continued to underperform. Now we have crude oil completely breaking down, trading in the 30s here this morning, right? The RSI for the ratio is oversold, lending a momentum confirmation to this breakdown in the trend that we are seeing. This is what we talk about, folks. We want to look for the areas of the market that are doing well. Energy has not been one of them. It's been a key rationale for us saying we want to avoid the group. Hopefully that has been helpful. Hopefully you've not been trying to catch falling knives in the energy space. Gold, on the other hand, remember on Mondays we look across asset classes. Gold has been a safe haven. We're trading up here near 52-week highs for GLD, above the 50-day moving average, above the 200-day moving average, above the breakout level with the RSI holding bullish ranges, indicating that momentum is with this trend higher. And I wouldn't be surprised to see gold extend this rally here today in a flight to safety. Look at gold relative to the S&P 500, right? We have a breakout here. We have a break to new highs. So when we're thinking about asset classes, right, when we're thinking about diversifying portfolios across asset classes, gold certainly has to be part of the picture. That's going to wrap us up for today. Head over to chaikinanalytics.com/test drive to sign up for that free 14-day trial where you can get my notes every day. Have a great Monday, everyone. I'll be back with you tomorrow.